The voice,
the heart,
the soul of the Cayman Islands.
Money Sense is brought to you by the Chamber Pension Plan. For further information, visit chamberpension.ky.
The Cayman Islands Chamber of Commerce Pension Plan. We're here for you. We are a non-for-profit member-centric plan with a democratically elected volunteer board of trustees representing all sectors of the Cayman Islands economy. Chamber Pension has an all-in expense ratio of 0.72% over 16,000 members, $430 million in assets under management. We were the first multi-employer pension plan approved by the regulator in the late 1990s. And today, we are still strong, secure, and are here for employees and employers alike. If you would like to join or request further information, visit chamberpension.ky. And for information as it happens, follow us on Facebook, LinkedIn, or Instagram. Email admin@pensions.ky or call 745-7630. The Cayman Islands Chamber of Commerce Pension Plan. We're here for you.
Money Sense, bringing an informed financial perspective to the Cayman community.
A very good morning and warm welcome to Money Sense. I'm Simon Caudry, and I have the distinct pleasure of being joined this morning by Amy Hubble.
Good morning.
Good morning. Amy, this morning we are being joined in the studio by two guests, Matthew O'Keefe and Lou Dimitrov, who are both from DART, and they are going to talk about property and real estate and how to understand the market dynamics. So good morning to you, gentlemen.
Good morning.
Good morning.
We're talking property, we're talking real estate, and it's a very hot topic. It's particularly in Cayman at the moment. People are talking about prices having gone up, people are talking about the scarcity of opportunities, and we want to come on to all of that. But let's talk about how we actually measure the property market, because I think it's something that if you don't have good data, you can't make good conclusions. And it's not always the case that we have good data in every country. So what's the landscape that Cayman has in terms of the data available, and how does that compare globally, and how does that compare to what our international peers are doing?
I think Cayman's very well set up in terms of the data availability. We're very fortunate to have the cadastral system that the Land and Survey Department look after.
Hang on, cadastral system. Explain what the devil that means to me.
Well, that's essentially carving up all of the different plots of land in the island and registering the owner. So,
okay.
So we know who owns which bit, and how much they bought it for, when they bought it, that sort of thing. The granularity of that data is very good. The accuracy of the data is very good. We use it a lot in some of the research and the analysis that we do. We also have the multiple listing system and the Cereba organisation, which are excellent. We take a lot of our information from them as well. Just in terms of analysing sales, you're correct, and it's a very hot topic at the moment. There's lots of lots in the paper recently. We took a look at the data from the Cereba system this morning. As an example, we're up at $737 million worth of sales in the
$737 million of sales this year.
This year, so far, as of
that seems like a big number.
Well, how does it compare to other years?
In the total last year, 2020, it was 647. So
hang on, we're in what month are we in, Amy?
Yeah,
October.
I think we're in October.
Okay, yeah. So we're in October. We've got November, two and a half months left in the year, and we're already, 20%, 30% above where we were, something like that.
But what about 2019? Obviously, 2020 and 2021 have got to be odd years across the board economically, right?
Surely only 2019 is an odd year.
Well,
2020 is an
odd
even
in
year.
terms of the
Okay.
year.
Sorry.
And a prime number.
Yeah, so 2020 certainly. Yeah, 2020 was a record, so it's already broken the record from 2019.
So 2020, in terms of sales, was a record year, despite it being an unusual year, and 2021 has already exceeded that, and we're only in October.
Through the Cereba system, yeah, which doesn't represent the entire market, but it's a decent chunk of it. It's enough to be indicative of what's going on.
And this is just residential.
That's the whole market.
The whole market.
Yeah, so that's commercial and land in there as well.
I see.
Is it when you're talking about that, and you said something there that it doesn't represent the whole market? I guess historically, once upon a time, almost all transactions happened probably through Cereba, and then now the internet came along, and people could sort of post their property for sale on the internet and you could take a private transaction. So is it possible that more transactions are happening? Is it philosophically possible more transactions are happening outside of the Sariba system?
It's certainly philosophically possible. It's a little difficult to track when you compare the total sales value of the through the Sariba system to what Lands and Survey are recording on their data through the valuation office and things like that. We think Sariba's probably increasing its market share, if anything.
Oh, really? Okay. Huh. Well, there you go. Okay, keep going then with where we are in terms of data and what else is going on in this market.
So we just going back to the Sariba numbers there. So we as I say, in 2021 we're already at a record number. That 737 million is the total dollar value is across 753 sales as of today. And that compares to 668 sales last year. So it's still an increase on the the absolute number of sales that are taking place.
Who's really good at quick math? Who can divide 700 and something million by 753 sales? I'm just curious as to what the average transaction. If I keep talking for long enough, will someone be able to?
Lou's got his calculator.
Yeah.
Yes.
Is it 1%, 2%, or?
Yeah. Well, it's 979,000.
The average transaction.
The average transaction.
Wow.
So
but that includes. So that's the average, and that includes commercial. So it could include a property of $20 million, $40 million, and it could include multiple smaller houses, multiple larger houses.
That's correct.
1%.
1%
increase.
Okay.
Oh yes, 1% increase on the average transaction between the 2 years. So from 2020, the average price was $969,000 US. This year so far, $979,000 US.
So not a significant difference in terms of the average sale price that's being kind of garnered, but just more in volume, right?
Yeah, correct.
So what do we think is driving that?
Well, I mean, first we probably should start with the explanation that is not an accurate way to measure changing prices. And the reason for that is that what you're comparing properties, houses, condos, commercial buildings of different quality. So what you need to do is you need to adjust for that. And actually, because of for that specific reason, Matt and I created an index, which is a residential condo index. We call it DOC HPI, and as an attempt to fix the problem.
Okay, so what you're saying is a simple average like that, because it includes a whole load of things.
Yeah, it could include a $25 million piece of land.
Which sells once every 20 years. So you adjust for all those things and simplify in the sense of, simplify it so that you're just comparing equivalent types of properties, so condos in this analysis.
That's right. I mean, what we do, it's a repeat sales regression, similar to the one that...
Everyone's getting their stats books out right now, so
yes.
Keep going.
If you've heard of the Case-Shiller Index up in North America, it's the same methodology that the Case-Shiller Index uses. So it's in its most simple form. It takes a condo A, let's call it, that sells in 2010 for $100,000 and then sells again in 2015 for $150,000 and then sells again in 2020 for $250,000. So we look at those three individual transactions and assess the change in value between the two or three, in this case, 3 different periods.
Okay, so you're taking an equivalent property and assessing the value that's really changed, as opposed to being distorted by different types of property transacting any 1 year.
That's right, yeah. So we compare the value, the relative change in value of the same piece of property over different time.
And how do you get the data for that then? Because it seems to me as though you go to the States, and I can go onto my Bloomberg terminal, and there's thousands of pieces of real estate data, the same for the UK, similar for Europe, same for Australia, Canada, but there isn't a lot of publicly available, it seems as though there isn't a lot of publicly available, easy to source data in the Cayman Islands. So how do you get this raw data to run these regressions?
Yeah, again, that's where we're very lucky to have Lands and Survey and the transactional data that they record. It's certainly more granular, I think, than anything regionally in terms of its accuracy and its detail. I'd go so far as to say it's probably more granular than the information that Land Registry in the UK holds. Insofar as, at least with condos, which we tend to concentrate on, given that they're more consistent to be able to compare over time. You can't extend a condo or build a garage onto it or anything like that. we were able to assess that a 2,000 square foot condo that was worth X 10 years ago is now worth Y 10 years later, and it's the same 2,000 square foot condo.
And I guess that's a fundamental problem, isn't it, that you've explained that, which is one of the things, it's all very well considering the same property, but you've also got to make sure the property hasn't changed its characteristics. So as you say, you could potentially upgrade a property, you could add a new roof, you could, I don't know, put some solar on, but in a condo you can't do quite such substantial changes as make an extension, which you could on a house. So that's why you specify condos as being very highly homogeneous in that sense, is
That's
it?
right, and it's condos represent more than 50% of the residential supply in Cayman as well. So we think it's a fairly decent yardstick to be able to use as an indication.
Do you think it's a good proxy for the whole market, or is it just a good indication of what the condo market is doing?
In the absence of anything else, I think it's a good proxy.
Okay.
Yeah, it's and we use the index a lot. I mean, it's if you allow me to go back to the Cereba data, at least it's so the example we used just now, 969,000 mean average last year versus a 979,000 mean average US dollars this year. As Lou says, it's around about a 1% increase in price. I don't think anybody here in Cayman would probably agree with you if you told them that house prices have gone up 1% this year. It's probably not the case. I mean, we can dig more granularly into that. So if you look at the single family home market, for example, and concentrate on that only through the Cereba system, that's gone from an average of 1.54 million last year to 1.75 million this year. So quite the jump. But then if you do it on the condo market, it's gone from 1.1 million average last year to 1 million this year.
So hang on a second. You're saying in 2021, this is using your data that you've standardized for all these extraneous variables. So you're saying that having standardized for all of that, condo prices in 2021 are actually lower than they were in 2020. Is that?
Let me. I'll clarify. This is the Cereba data, and we're just talking about mean averages.
Oh, okay. This is Cereba data before you do your standardization.
That's right.
Okay.
Yeah. So we read a lot of the time where people compare the mean average from one year to the next, and as Lou's talked about, it's this quality mix issue means it's not really a reliable indicator. So we use the repeat sales regression to get information for the condo market specifically. Based on that, we think prices in Cayman are up about 11% so far this year, just in condos.
So that's an important thing, as a good learning experience there for people as they reach for their stats textbooks to understand regression, means, and all the rest of it. A headline number which says, you take the Cereba data that's published and it says the average, the total, the number, that's your average, and it's gone down in 2021, and people are there scratching their heads saying, well, how's that possible? It seems that everything's become more expensive. You're actually saying, well, if you take the adjustments that you need to take to standardize, so you're comparing like with like, as opposed to a new build compared to an old build, and only new builds were sold 1 year and only old builds another. Actually, when you make those adjustments, condo prices have increased by, did you say 11?
11%.
11%. So that's a substantial increase, and that's, I don't know whether that's in line with what people who are listening think is what they'd guess the number to be, but it's certainly a big number, certainly, right?
Mm-hmm, certainly. And we think the 11% that we've seen so far this year is kind of in line with what we've observed the last few years on Ireland, as everybody's well aware.
So that's what it's been going at for the last couple of years as well.
We think across Cayman, probably double digit every year for at least the last 4 years. There's obviously different sub-markets within that. What's true in West Bay might not necessarily be true in Lower Valley, but if we look at 7 Mile Beach, that's the kind of the poster child for a lot of the inflation that people read about in the media. Those were we think that started really in earnest at the tail end of 2016, to the point where our index for 2017 shows prices on 7 Mile Beach jumped by 30% between 2016 and 2017.
Gosh. Okay, well, look, we've got a lot of data that you've given us now. We're going to take a short break, and I think straight after that, what we're going to try and do is understand why the numbers have pointed to where they've pointed to. So you've given us the raw data, and now we're going to reach inside Lou's mind and try and understand what's been going on. So join us again straight after the break.
The Cayman Islands Chamber of Commerce Pension Plan. We're here for you. Are you aware of the performance of your pension plan? The Cayman Islands Chamber of Commerce Pension Plan provides quarterly fund fact sheets for our members to stay informed with the plan's performance. For the year ended 30th of April, 2021, the various life cycle funds have provided returns between 10.5% and 43.2%. And our all-in expense ratio for year ended 30th of June, 2020 is currently the lowest it's ever been, 0.72%. Visit chamberpension.ky to review our fund fact sheets. You can see the performance as far back as 10 years. Remember that pensions are a longer-term investment strategy. Focus on the long term rather than the short-term returns. The Cayman Islands Chamber of Commerce Pension Plan continues to perform for you.
This is
Money Sense, bringing an informed financial perspective to the Cayman community. Brought to you by the CFA Society Cayman Islands.
And now, more Money Sense.
Welcome back to Money Sense and our conversation on the Cayman property market. Before the break, we talked about the raw data that's been exhibited here in Cayman, and we came to the conclusion that over the last few years, the condo market, of which we have the best data, has been seeing gains of 11%. Now, Amy, I think you want to talk about what the future holds, so let me pass over to you.
Yeah, well, when I'm listening to what you're saying, I mean, you have these kind of one-off, one-year data points that we're hearing, and it's kind of, there's an increase of 11%, or is it an increase in 1%? Is that really meaningful to a buyer or a seller? And what can they take from that, or even should they take anything from that?
Okay, so we have not only one point, we have actually historical information since 1997. So we have annual changes on a year-to-year basis since 1997. And to answer your question, probably no, right? You shouldn't be looking at 11% increase. You decide whether you should buy or not to buy, or to sell or not to sell. So what is more important is the long-term trend. So an interesting stat here would be the compounded annual growth since 1997, and that is around 4% in the Cayman Islands. What you could also look at, and that's also interesting, is to see by how much the price is contracted in a period of hard economic times. Between 2008 and 2011, that was one of the worst crises in housing in recent history. So prices declined by around 14%. So you could look at that and kind of prepare yourself for a conservative scenario if you're worried about it. We were, by the way, many people asked that question last year when there was in the middle of the lockdown. Many people were concerned what could happen, and none of us knew. But it's just one scenario that you could use in this kind of.
So you're using it almost as a scenario analysis. If something goes a bit pear-shaped, when it did, things fell by about 14% here in Cayman. In effect, is a way of interpreting those data points.
You could use it. Again, the history is not a guarantee for future performance, but
we say that occasionally.
We know about that a little bit.
We occasionally warn people about that.
But it does beg the obvious question: is the property market in crisis versus is the economy in crisis? And from what I'm hearing, the answer is no, in terms of both a long-term trend and, even more specifically, the last 2 to 3 years.
Well, I'd say that the answer is it depends. So we probably should go back to the beginning of last year.
I thought you were about to say beginning of time.
No, unfortunately.
Please, let's not go back to the beginning
Martin and
of
I
last
would love
year.
to be able to get to go to the beginning of time.
Well, we can talk about what the Big Bang led to. This would be... Carry on, sorry.
No, since property has been an established factor, so that's that type of history, I'd say more recent history. But what happened basically last year is, what we think happened last year is COVID came to our shores. And then as a result, we had to implement certain restrictions. We had to close the borders. And the first thing that happened is that tourism pretty much disappeared. And as a result, what we could see is that we could see a decrease of tourists. So right away, there was a number of properties which were, they were mostly in the Selma Beach corridor, but also in many other places which were in the short-term rental pool. And many of those were added to the existing supply. So supply pressures went up. At the same time, many of the employees, that didn't happen immediately. Some happened immediately, some happened after. But many employees most of them employed in hospitality, but many others had to leave the island, and as a result, there was a fall of demand. So this is actually known in economics as a downward shift of the demand curve.
Here we go. Now, I remember one thing from my economics course here. We've got increased supply, and we've got less demand. That should lead to prices falling.
Right, and it did, but
and Matt's just said they went up 11%.
It did, but it didn't. But the direct impact is it impacted the prices of rent. So that was the impact. So what we think happened is those prices fell by a little bit more than 10%. So around 11%. So that was the immediate impact.
So rental rates declined by double digits.
Correct.
But if I'm back to my basic economics again, the value of the asset that you hold, if one were to take the traditional approach of discounted cash flow, so the value of the cash flow that asset generates, if the value of the cash flow it generates has decreased and it's gone down 11% in 1 year, so you discount that, the value of the asset should therefore logically also be worth less, not worthless. Sorry.
But you also see, as he was saying, there's more supply on the market. Ultimately, without tourists coming in, maybe the owners of them were saying, can't afford to keep it. Let's see how we can,
so why do
if we should sell it.
So that's the challenge.
Yeah, and you basically are talking in a classic economic sense.
I'm a classical person.
It's basically, it's actually a mistake all of us make most of the time, including myself. So basically, you assume that everything else is going to be held equal. So, and it never
Ceteris
is.
Paribus.
Right, so basically...
Simon's going to lose his mind over here. Destroy everything he's ever believed in.
If the central banks do nothing, if the governments do nothing, what that should lead to is eventually it should lead to a fall in prices. Mm-hmm. But it's very...
So I'm right in theory?
In theory, you're right. But it is very unusual, although it has happened in the past. It has happened... I would say in a more recent history, it probably was one of the reasons for the 1930 depression. But in this case, this is not what happened.
Okay.
So, and the reactions this time were actually very swift and very strong. So right away, the Federal Reserve implemented very strict, very strong monetary measures. So they lowered interest rates drastically, and then increase the money supply. Mm-hmm. So if you look at M2 money stocks, that's just one measure of all dollars that are in circulation. Savings account, checking accounts, cash, etc., money market accounts, mutual funds, everything else. You would see that something like more than $5 trillion were printed in a period of about 18 months. And just to get your perspective, that's about a quarter of all dollars in circulation. That is also more than what we had in the economies around the world, and we're talking about US dollars, for most of the 90s, probably even all the 90s.
Okay, so the Fed produced $5 trillion sort of out of nowhere. How does that affect the Cayman property market?
Right. So if you first measure the impact, you realize that what happened is that monetary impact was stronger than the impact on demand. So if you use our, let's say, the measure of rents, about 11%, and if you just take the difference in interest rates. So interest rates here, mortgage rates fell down by about 200 basis points, about 2%. So, and if you do a simple simulation, assuming you were interested in a home before, and how much more you could pay for the same home, you end up with about 18% more. So these measures were much stronger. So just that on its own is a stronger reaction than the negative, actually downward shift of the demand curve, right? So basically the monetary measures were stronger than that. And on top of it, you have fiscal measures. Governments around the world, not just in US, were basically, they funded unemployment for borrowing. Mm-hmm. And in many countries, actually, people received unemployment benefits which are exceeding their previous salaries or paychecks. Here, the governments, for example, the government allowed to access the pensions, which had a similar impact. So increased
like money
liquidity,
supply.
Right? So basically increase liquidity, and those measures were stronger. And again, at the end of the day, you have to understand that we measure real estate in dollars, and we track prices in terms of dollars. So when there's more of it, more dollars in the system, prices go up.
So, go on, Amy.
Yeah, but what does that mean for affordability? And is there going to be basically a top on this in terms of where wage growth is not going to keep up, where ultimately those property prices, there will not be the buyers, there will not be the liquidity in the market? What happens then? And I know that I've read across Jersey trying to limit foreign property ownership, even Canada trying to do a temporary thing. Do you think that that would be, I think we would all agree around this table, no, but I'd like to hear you kind of wax on it a little bit in terms of what could the ultimate either benefits or disadvantages be of trying to limit foreign ownership to increase affordability for local residents, local Caymanians?
Okay. It's a really long topic, actually. So I probably should divide.
And
it
Amy's
into
given you
parts.
precisely 2 minutes to answer.
Yeah,
so
I was
that's
just
all
giving
right.
a 2-minute warning.
So first of all, I should say that we should go back to the central issue. So many people talk about it, but I haven't seen or heard of too many who have the right data. And unfortunately, we don't have the right data, because when you talk about affordability, there are two parts of the equation. One is income levels, and second is property prices. So we have an estimate of how much property prices are, what property prices are changing, in what directions they go. We don't have good estimates about what income levels are, and you cannot take an average. So you have to be specific here. So just because the average income increased, that doesn't mean that it increased for everyone. So you have to make it very specific, which makes it very complex. So unfortunately, we don't have that data. And usually, interesting enough, that many people that talk about it don't have it either. And if I think about who might have it, I can only come up with perhaps the banks.
Because they have to do credit applications. They ask people, what income do you earn? How has it trended over the last 3-4 years?
Correct. We've looked at a very high level on the overall lending levels, and just compared that to the growth of GDP. If there was a massive increase in lending or decrease in lending due to affordability reason, you'd see a trend in that direction. And similar to like the 2008 financial crisis. And we haven't seen any kind of weird patterns or anything like that, but it doesn't mean there are no pressures on the. As a matter of fact, there's likely pressures on the affordability in the market here, and that is a trend that is happening in the entire world. As a matter of fact, Pharaoh Powell has talked about it on many occasions.
I guess when you look at affordability, if you take, say, the US as a proxy, you've seen incomes at the higher than median level increase quite rapidly, and you've seen incomes below the median not increase at anywhere close to the same speed. So the bottom quartile of incomes have stagnated a lot. Top quartile have gone up an awful lot. And then if the average house price is also increasing, and yet lower income people aren't seeing wage growth, that becomes more and more unaffordable for them, and that's the challenge. But does potentially stopping foreign buyers, does that improve the affordability, because it takes away demand, and therefore well, I was about to say, then it reduces prices. So that might be bad for people who own properties.
So you're going on a different topic here. I'm not a policy economist or government.
Well, it becomes
policy,
a very political issue.
But let's just make it simple. Let's just talk about in terms of real estate prices. And by the way, I would love to have researched the topic, but I'm waiting for this one case where. So I read about it in the newspapers all the time. Where this country implemented it, that country implemented it, but I never read about success. So something where a good article where 20 years into it or even 10 years into it, they implemented it, and everyone's happy, and the economy is doing great, and they achieved the target. But by the way, what is the target? So what do you think the goal here is basically? Are you trying to affect the future price increases, or are you trying to affect the price? I don't think you're trying to increase the income, right?
I'm not going to try and guess what politicians might be thinking, but clearly...
Perfect for buyers, terrible for sellers.
Well, the focus is to decrease the price of everyone's home but your own, so that it becomes more affordable, but yours goes up still. I mean, that's because no one wants to see their value of their asset.
We can all agree on that.
That would be great if you could do it. But
I mean, that's sort of the intuitive idea, which is decrease prices, as long as it's not ours, and that makes it more affordable. The problem is a lot of people own property as part of their pension retirement, and that income stream is important. So if you decrease the value of that asset, that reduces future prosperity as well. So it has a knock-on effect. Now, fortunately, before we get embroiled in policy matters, I think, if I'm not mistaken, we are almost out of time. We managed to have a 30-minute show or thereabouts, and we get through about two-eighths of or 1/4 of our topics and our questions.
As usual.
As usual. So thank you to Matt and Lou for joining us this morning. It's been a real pleasure. Thank you for a brief education on neoclassical, I think I might call you, economics, and a little bit of regression stuff earlier. So that was an absolute delight to me. Anyway, to thank our listeners as well for joining us. It's been a pleasure having you this morning. And please do tune in again in 2 weeks' time. As a final reminder, we do, of course, have this show, which will be as a podcast, Amy, on our website. And then, of course, if you want to send us questions, it's moneysense@candw.ky or tweet us at
Money Sense Radio.
Money Sense Radio. There you go. With that, please do tune in 2 weeks' time. Thank you.
Money Sense is brought to you by the Chamber Pension Plan. For further information, visit chamberpension.ky.